I'm Jason Hall, a Director with Cardinal Economics and Finance, and this is the first edition of Evidence on Value and Risk. This publication provides commentary on current issues in economics and finance, recent equity market performance in the United States, and in particular the performance of companies headquartered in the state of Michigan. In compiling this first issue, we analysed a suite of 29 listed companies, the Michigan Index, to estimate recent share market returns and prospects for earnings growth. So let's look at performance. In the last 10 years, the Michigan Index has earned returns of 9.7% per year, which is reasonably robust share market performance considering that in just the second year of returns, the index lost 44%. On average, over the next 8 years, the index generated returns of 19.5% per year. But even more interesting is to understand the differential impact on performance that different companies have. And there's one company in particular which made the highest contribution to index performance over 10 years, and that was Domino's. Domino's alone contributed 0.6% per year to that 9.7% per year performance. And how did it do it? Relentless pursuit of revenue growth via new technological applications to order pizza. As a social experiment, the results are in. There is absolutely no limit to consumers' preference for convenience when it comes to saving that fraction of time. But what isn't quite so well known amongst the market, especially commentary in the financial press, is Domino's fiscal discipline in terms of leverage, share repurchases and increases in dividends. This is the financing decisions which converts those investment choices into share market returns. If we look at expectations for earnings growth, for the entire index, the market anticipates real earnings per share growth of 4.4% per year over the next 3 years. But again, that performance is not evenly distributed. For the big two automakers, Ford and GM, the market anticipates flat or even negative earnings per share growth over the 3-year period following those companies' performance rebound in 2015. For the remaining 27 companies, the median real earnings per share growth expectation for 3 years is 6.9% per year. If we look at multiples, the index currently trades on a price earnings multiple relative to year 3 forecast earnings of 9.9. Looking closer in time to year 1 and 2 forecast earnings, the multiples are 11.1 and 10.4 respectively. Thanks for listening, and your feedback is welcome on this first issue of Evidence on Value and Risk.